So yesterday we had an FOMC meeting, and the Fed's statement has been perceived as a little bit hawkish by the news media. Now, considering these are the special geniuses who get every move correct, I don't see why they would be wrong this time. Yes, I am dripping in sarcasm here. So I listened to the Fed statement, and I didn't think it was super-duper hawkish. The only thing that struck me as a little bit more hawkish than dovish is the fact that they have removed their time frame constraints. And I think that's really what kind of spooked the street yesterday, that they could now sort of do it meeting to meeting, or the street doesn't like change, particularly when it comes to the Fed and the supply of the easy money drugs. So I'm seeing the Fed as being data dependent, and if they are truly going to be data dependent by their own standards, by the data that has been coming in, the Fed should be cutting interest rates, not raising interest rates. The GDP was an abysmal number. The unemployment number was sort of, I guess, good, but it's sort of the way you portray it. The participation rate is terrible. I mean, it's like the lowest since 1978. The quality of jobs isn't so great. It's a lot in the service industry, and the economy is just, in my opinion, not grabbing hold strong enough to warrant a Fed, I guess, hike. Now, does that mean that the Fed won't hike? It's possible that they may. I believe if they do hike, it would be in a meeting that has a press conference, and I think that Janet Yellen will do her damnedest to kind of disguise any type of a hike to looking like either a one and done or that they're on hold. I really don't understand why the Fed. I mean, I've taken classes on Fed policy in my days at NYU at Stern Business, and they look at like multiple sets of data. It's not just like one set, oh, we had a hot employment number and we're going to stick to that. When the numbers are crappy, they like to say that they're transitory. So I don't really see why the Fed would want to jump off the rate raising cliff at this point until they see a few sets of data that would kind of confirm that we're solidly in this recovery. The recovery, I think, has been rather mild, to say the least. I mean, you have riots in the streets in Baltimore, and this may all be like guised in race, but it's really just poor people who are frustrated. And I think that the Fed knows this. Not to get too political here, I don't want to get too into that. I'm just commenting on what I'm seeing. I'm not going to. Those of you who know me and have followed me, I tend to lean a little bit more conservatively in those circles. Not so much socially, but more so in terms of policy. So let's get cracking on some levels now that we've sort of set the context. So I had said on the stream that I thought that the Fed Day range was going to be really important, and that kind of coincided with the range on Tuesday, which is proved, I believe, to be the key here to the market. The high of the day there was 211.50, and I had done a call-in on the Shadow Trader show with Brad, and I had said that I thought a lot of shorts had their stops and they were camped out up there. And if we got through there, then we could see the shorts run. But on the contrary side, the flip side, I thought that a lot of people would have their stops below that reversal day hammer low, and that was in SPY, the 209.33. And you can see today, once we really got through those levels in the 50-day moving average, that's really when the selling accelerated. And it didn't do it on really super-duper convincing breath. I mean, the NYSE today finished up at under 3-to-1 negative. The NASDAQ was 4-to-1 negative, and that was even with Apple down ginormous. Apple was down almost $3.50 today, and that you would think that would be worse. The one thing that I would say that is sort of the troubling here, at least is for the bull case, is that we did close below that 208.97, which is a level I've discussed in the past as being sort of the upper distribution high. And we're still kind of between the upper distribution levels, believe it or not, even with today's sell-off. that really starts, or it kind of trails off at 207.84, and there are a bunch of levels between here and there. There's between the distributions. If we start getting more into the middle distribution, you have the 100-day moving average roughly around 206.79, and you also have a reference chop range of 206.42. So that's sort of like the immediate downside risk I see if we do get a little bit more slippery the next couple of days. There's a lot of like chop and volume around like that 206, 207 range. So I don't know if we necessarily knife right through it. Although if we do, that would be very telling. So I'm also noticing a few things in terms of price action. I know a lot of people have poo-pooed this on the stream, and they say, oh, why do I post about MOC? It doesn't work, it doesn't help. MOC just means the imbalance of the orders to buy and to sell from big institutions. These people have been selling for 3 weeks straight. They have enormous size. They need to get out of positions if they want to buy, if they need to get into or out of positions. It's not like you or I who want to buy, 100 or 1,000 shares of Apple and we could, be filled in 3 seconds. These people have to move tens of thousands of shares, if not even hundreds of thousands of shares, and they need to be able to operate and not be able to depress or raise the price on from their own buying or selling. And they've been at it, hitting the bids. They've been selling for weeks. So that's why some of these rallies up have felt very lethargic, and the breakouts haven't really been holding. If you notice, also in terms of qualitative observation, and it's starting to become more quantitative, that companies report, and if they have a good earnings report, they have a rally, but it's rather muted. And sometimes the rally will fail very quickly, i.e. what happened with Apple. And I see this being as a result of people who have chased the stocks, and it's very weak hands, people who are buying, who are sort of hoping to flip. Like, they're buying at 130 and hoping there's going to be another sucker, sort of, so to speak, to pay 133. Or someone buys it at 133 and they're hoping that somehow someone's going to pay 140. And yes, that is the game of the stock market, right? To get some people to pay for things for more than you bought them. The problem is when something runs up into earnings, a lot of that buying power is exhausted. And in stocks that have low short interest like Apple, who is going to be the forced buyer? Like in Netflix or stocks like that, or Tesla, companies that carry huge short interests, when there is that price expansion higher, people have to hit the bid to cover, and that fuels, if not artificial, but real demand. So the problem I'm seeing with a lot of these stocks that are reporting is that people are already in, they're already loaded to the gills, and the stocks just need a little bit of time to sort of digest that and correct. We were at the top of the range. We did have a little bit of a look above with regard to SPY, and now we're failing and coming back down. So I would say that a move to the middle of the range isn't necessarily super-duper unexpected or unhealthy, and guess what? We're almost there. The tape today did feel pretty awful. A lot of the momentum names are starting to kind of blow up, so to speak. For example, after hours today, LinkedIn. Yesterday was Twitter, and really the day before. These were stocks that I guess had been one that had a lot of skepticism, and they have now, I guess, all those shorts kind of capitulated, and now that they've been bought up, there's not really that many real buyers behind it anymore to keep the prices high. That being said, I think that the market is either doing one of two things, and we're not going to know yet. We'll know soon, but we're not going to know yet. That either it's just pulling back here, and it's a normal, average garden variety correction, and maybe there is some room to the lows here, believe it or not. If we, the last time we sort of had this seesaw action, it was 3 touches of the lows, and I had mentioned in my weekend video, if you guys aren't following that, you could subscribe to my my stream on long day today, on YouTube. It's Justin Pulitzer Trades. There's a link in my profile on Twitter, which is @JustinPulitzer. If you're not following me, please start following me. I post a lot of good stuff on there. At least I think so. So The question is if we are going to have that 100% retracement, and the answer is it's not going to be clear yet. That would be down to 204, believe it or not, in SPY. And I think the tell for that is going to be looking at some of the other indices. Like if you take a look at IWM, for example, that was the one that kind of really took it on the chin today. IWM had a series of poor highs, and then it suffered a pretty big reversal day, and then today it closed just barely over the 100-day moving average, well below the 50-day with a gap and go, and it sort of broke the trend within the up channel, or I'm sorry, actually broke its up channel. Primary trend in IWM is a lot lower. It's like, believe it or not, down like a 111. But there are a lot of levels in between here and there, and we're going to discuss them right now. So I think that if IWM could sort of reverse itself here, it would be able to, and it can hold this like 120.97, then, you know, there's sort of no harm, no foul. If it does wind up coming lower, then there's sort of a bit of a buffer zone between this 120.97 and 119.39, which was kind of like the chop zone that it broke out of. So if we start getting in there, it's not full-on bearish, but it starts getting a little bit more iffy and looking like there might be a bit of a short-term top. If that area fails, we should pretty quickly come down to, dare I say it, 117.37, which has been the sort of the Mason-Dixon line, so to speak, for bulls versus bears. However, this time is a little bit different, that it coincides with the 200-day moving average. So that area would, to me, would set up between that 119.39 and the 117.37. If we can break there and come down, maybe it would be good to do some type of like a put ratio with the 117.37 as like the lower end of it, since it was such resistance before. Maybe now it's going to be support. I would probably just play it a little bit safer than sorry and just use some strikes a little bit lower than that. So I would be looking to do that into some weakness. I would love to also, I mean, if IWM just winds up being like a complete knife free fall, it would also be a good area to sell some out-of-the-money puts into, near-dated, of course, to play for some type of a bounce. And that would give you some high IV to be able to sell into. And if it does wind up coming down really sharply, it should be pretty quick. Just below there, there's a gap fill, which is like 116.76. I feel like I feel like I'm getting a little bit too much into the charts here. Since I can't really show them to you, let's just speak a little bit more generally. I'm going to be a little bit more general than specific in this sense. I think what you really need to look for is to see how price is reacting. And from what I'm seeing, good earnings are rewarded with either muted responses or sell-offs, and bad earnings are being absolutely demolished. Twitter got destroyed. LinkedIn is getting destroyed. Good earnings, even like Facebook, for example, got beaten up. I mean, they had a bit of a revenue miss, and it was attributed to a foreign currency issue, but they wound up whacking the stock anyway. However, we are down into this a support area. I think somewhere between 77 and 78 is a buy the dip area for some type of a bounce. My one caveat that I'm a little bit concerned about with Facebook is that it's below the 50-day moving average, which had been really strong support. And actually, the same thing happened with Apple. Apple is below that. If you've followed my stream, I've been talking a little bit about Apple even before the earnings, that 125 might serve as a put wall. We are trading a little bit below there in after hours now, and we did close slightly above it today. But it wouldn't shock me to see that as being like some type of a pin for Apple tomorrow, because the volume in the calls and in the puts is absolutely ginormous. Now, Apple did today lose its 50-day, and it's let me just pull up the chart. It's also below the 20-day, which I think is sort of the litmus test for Apple to be bullish or bearish. Now, Apple did have a bit of a look above the range and fail, and now we're sort of back into the middle of it. So theoretically, this area should hold, correct? If not, I could see that I could make the case and the argument for the stock to come back down and test the range low, believe it or not, close to 121, 122, and possibly even overshoot a little bit to the channel low, which will roughly coincide with the reference breakout, which was that 119.75. I do think that area will serve as some type of a reference buy, although I would have really liked to have seen it tested already. It hasn't. It's also roughly 120.52-ish is about the 100-day moving average. So I think that area, maybe there's like some type of a move or an overshoot. That area to me would set up as a right or right out buy if this 125 area fails. 125 really might be it. This to me also is a good right or right out type of a trade. You know, just keep your stop a little bit below the 125 if you're so inclined. Or if you want to do something like protect it, you could do some type of a put spread or a put ratio. Now that the IV in Apple has contracted considerably, I think that would be very useful. Although it did get a little bit of a bump today, not surprising with the stock being down. You know, the typical area, I had discussed this yesterday, it was around 25, 26. I thought that would be the good IV to use to hedge Apple, and now it's getting a little bit accelerated again. It's really not like crazy out of whack, and if I was long, I'd probably use it for some type of a protection on a 125 snap. So that is my thinking on Apple. The real question also with Apple is going to be, where is it in relation to the Qs? Obviously the Qs are very heavily weighted with Apple and Google, and if you take a look on the Q chart, it failed the other day. Sorry, it's allergy season. My nose has been driving me crazy the last few days. If you take a look, the Qs is sort of sitting right around the 50-day moving average. It closed a little bit below the 20, but we did close just above the 50-day MA. So if that starts breaking and we start losing Apple 125, you've got to be thinking the Qs are going to come down a little bit. One way I always like to play Apple, and you know, some people always, this is funny, I call it the money line trade for those of you that like football and like to bet. I always say that if you want to play Apple long, and you want to hedge it, one of the ways to do it is to short the Qs. So I think that would still work. Like if you want to play long Apple, you could use a Qs put spread or a put ratio, or even just outright short the Qs versus Apple and use that as a hedge. For me, I like to be a little bit more directional. I like to have a bit of, particularly since it's not earnings, but I think that the issue with Apple is going to resolve very soon here, and it's going to resolve in the Qs. Now, if the Qs wind up breaking, June, I see that I like the 115 strike, by the way, for a put sale. I was actually thinking about selling those today. I may tomorrow if we wind up holding the 125. I do think that one of my follow, June, is talking about Apple selling the 115 puts. I like that strike. I think that it's the really the larger channel support, and I think the risk at that point is really down to like the gap fill, which is 109. So between here and there, there'll be bounces and levels. I would assume dangerous assumptions, but I would think that area is probably quote unquote safe. And I like that she did that into weakness. It's better to sell puts into weakness than into strength because you benefit from the higher implied volatility. Sometimes when you get the bounce, you not only have direction going your way, but you also have the IV contracting, and often that could be more important, believe it or not, to the price of the option than the actual direction of the stock. Go figure. But that's really how options work. Sometimes a lot of people, and I've been guilty of this myself, is to sell puts as a long proxy and do it sometimes on a breakout, and I'll sometimes have to take heed on that because it's we'll discuss FireEye in a sec. So that you really want to sell puts into those down moves as opposed to playing for the breakouts with it, unless IV is really super jacked. So a couple of stocks I had discussed on the stream today, I was a little frustrated in was FireEye and Gilead. I actually wound up getting stopped out of them both with, I wouldn't say sizable losses, but any loss to me, I'm not happy about it. Really was just a bit of a flesh wound, not a big deal. But again, I don't like getting stopped. I don't like losing money. The setup for me with FireEye was really that I liked it as a long against that 50-day moving average, which kind of held with almost tweezer bottoms yesterday and the day before. Today was a break below those and hence a stop out. And I also didn't like that the rally yesterday couldn't hold over that 43.28. So I was a bit of I was a bit skeptical on FireEye, even though I really like the story and I'm kind of bullish on it. Again, I have a bit of a sordid past with this stock. I haven't liked their management, but I like the story. It's kind of crazy, right? But I didn't feel very comfortable with FireEye. The fact that it lost that reference, there had been a reference high at 41.82. You had those double bottom lows, and you couldn't hold over that the sort of the inverse head and shoulders neckline breakout, which I had discussed on the stream the other day, which was at 43.28. So someone was just asking me about, I didn't catch the name, it just flashed by quickly, but I was saying that I would be careful with FireEye below 43.28. Their numbers came out, the numbers were okay. The reaction again, to decent numbers is to sort of pop on an inside move and then sell off. So if you're currently long FireEye, I would be a little bit cautious. Again, anywhere below that 43.28, you can see the pop high never even got there, which is kind of a little bit disturbing. If we get back over there, then I think it could be played long. If you're currently long, I would be a little bit cautious under that 41.82, which we're now back over, and we had a bit of a reversal candle after hours. That the low was 41.35, so that to me would anything starting to get below there, that's now a higher low with a fairly large emotion bar. If we get below there, I'd be a little bit more cautious. That's my opinion on that. Gilead is one I had been a little bit bullish on, but the thing that got me to sort of, this is good. This is actually really good. I feel often that you can learn more from trades that sort of go awry, at least for me to teach you guys some stuff, than if on winners and saying, oh, this was a big win and here we go. So let's discuss the anatomy of Gilead and the stop out and why I guess I lost my faith a little bit in it. I had been short puts and long a put ratio. I should have stuck with it. It would have been a nice winner tomorrow. Wound up being a bit of a small loser. Nothing, again, not a big deal. But I believe in sticking with discipline. Often you won't be rewarded for it, and you'll always remember the time that it went the other way, and your discipline did you wrong. But discipline also helps to protect against outsized moves. Like, I'm going to discuss Yelp after this also and how I traded that yesterday and how I avoided being mutilated. So the story with Gilead is I liked that it had a confluence of events in terms of moving averages. It was like a cluster of moving averages that were, believe it or not, it was the 50, the 200, and the 100 MA and the 20 MA, all roughly around like 101, 97, 102-ish area. So I like that as a long reference point. And you also had a reference low of 101.14. Now, my fear with Gilead was that we were now below that today. We were below the swing low from the last move a little bit, and this sort of 100 to 98.37 has been sort of the line in the sand for longs and bulls, and we've been chopping in this range so long. I was worried a little bit of trader fatigue, where people who have been long this are just finally fed up, and if they blew the number, they would absolutely sell it. And we've had this kind of season of outsized moves. So the reference support down there was like 95, which would have been, a fairly sizable move and roughly within range. But if we were to have an outsized move, that could have taken the stock, believe it or not, down to like 86 or 87, which was the reference low of the last time they missed. And if I were short and I saw this stock snap, I would probably step on the gas to the downside and be looking for that type of a move, knowing that there is all this supply up here of people who have been long for a long time and now are wrong. So that was sort of my impetus. Now that I saw that that very visual references of the moving averages break and the stock come down, I just figured I would take the small loss rather than have to suffer total amputation tomorrow if the stock wound up gapping down and have it really ruin my have it really ruined my day having to defend a position like that rather than take advantage of an opportunity like that to buy and to maybe sell some puts into it, the true support. So it's just a matter of it was really more of a matter of capital being liquid and being able to be open and be open to opportunities and not having to be on the defensive. I try to avoid that in every instance. Like a couple of other things with regard to that was someone was asking me on the stream while I was setting up why Facebook was down after hours. And it was in sympathy clearly with LinkedIn. And I think one of the mistakes people make is they look at things that they own or are involved in, and they look at it in a vacuum. They don't see the sort of the forest from the trees. I was also not liking the SPY was below the Tuesday low. The IBB now is on a confirmed break of the 50-day moving average, which had been the support multiple times, at least almost three times now, on the fourth test breaking the trend, sort of the channel within the up channel within the up channel, and today it's sort of settled on the 100-day moving average, but it's still closed below the swing low from the last sort of bounce. And my thinking was that IBB was weak, SPY was weak, and Gilead, was breaking some support. So it was sort of a three-pronged thing that got me that sort of ran my stop, so to speak. And you'll find, like I said, often that those things will be very frustrating. It can reverse on earnings. Earnings can change patterns very quickly. But I just didn't want to get myself, my what's caught in a ringer, so to speak. Now, let's talk about Gilead. After hours right now, the stock is trading really rather mutedly. They had a dividend. They initiated a dividend. They had pretty solid numbers, although I do have to go back through those Hep C, the Cymbaldi, and the one with the H. I can't think of it. These drugs have these crazy names. I do want to go look back through those. One of my concerns was that their compares were going to be a little bit tough because they had just come out last year. And some of the analysis I had been reading was that they might have some tough compares. So I do want to go back through that. But Gilead, had really great news. Again, another stock with pretty fantastic earnings. And the stock reaction is junk. I mean, the stock isn't really rallying. I mean, it's below the low from a couple of days ago. So, I'm sorry, below the high from a couple of days ago on great earnings. I would like to watch this. I think if the stock, by the way, can get over this, the spike, the after-hours high spike of the 104.56 and clear 105s, which have been some resistance, then the play is to 108. But that hasn't really happened. Like I said, we're in a responsive market, not initiative, meaning that when we ping these levels, people are sellers rather than initiating the buys, and sometimes there's a bit of the stops are run, shorts are run, but then the stocks don't have follow through. They come back down. There's no initiative buyers. So I'm just very cautious on these stocks. I'd like to see how this works. I may, if the stock is weak tomorrow, actually initiate, again, put back on a put ratio, looking for some type of a move a little bit lower. Although I would probably be a little bit careful with that, at least I would be careful with it just in the sense that you saw what happened with Apple. It kind of hesitated a bit, and then it dumped. With a put ratio, you really want the stock to come down, but in a controlled way, not in like these major gap types of ways. Like if you were long, for example, if you were short puts, or if you were short or long put ratios in like LinkedIn, for example, you're long now. I mean, they probably ran through. I mean, the stock had a huge move. So, speaking of which, LinkedIn may present itself with a opportunity. May present itself an opportunity to sell puts into. This like 202 area had been support. I know that 163. Let's take a look. Yeah, it looks like LinkedIn is sort of catching itself a bit. There is actually a primary trend line a little bit below, and I'm sure everyone who chased it isn't aware of this, but there is primary trend, depending on where you draw it from, between 163s and 168s, 169. So I think put sales of those strikes, if the IV is still really jacked on the open tomorrow, if you could get off some near-dated ones, and I mean no longer than 2 weeks max, and you can get some decent premium out of that, then I think that the puts down there probably are sales, because the stock tends to gap and sort of meander for a while. So I would think that it's possible that that area could be some good support, or do some type of put ratios. How's that? Use the IV to get a larger than normal spread on for a credit that you normally couldn't. So you do something like buy into one of the higher strikes and then sell 2 times the amount below and benefit from that jacked IV and be able to get your spread wider than you might normally to benefit from the price differential. Actually, that might be the better play. I might do a combination of both in 2 different time frames. Let me do a little work on it. I'll post maybe some of the ideas on the stream tomorrow. So that is my thinking on this. So I've got to cut this Periscope short at I got to get out of here at 5:30. But maybe we'll take some questions. Does anyone have some questions? I'd rather Priceline and Expedia. Yeah, Expedia beat. I actually had been playing Expedia earnings with a put ratio, believe it or not. I'm actually fairly bullish. I was fairly bullish on Expedia. I do think it may run into some resistance up at near the 100 area. That had been the reference high. If you do get through that 100.51, you might get some type of a Fibonacci extension higher. But let's see how that handles tomorrow. I'm guessing it might attract a few sellers. If we do get through it, then I think that the path of least resistance is still higher. Although keep in mind the backdrop, we are in a market that is acting a little bit kind of squirrely. Priceline, I do think that if you take a look at Priceline here, it sort of was fighting like 1, 2, 3. For the last few days, it's been fighting the down channel. Now, if Priceline can get over the down channel, then I think you have a bit of a right or right out type of a long. And the way it looks like it's going to gap because of Expedia, and it might gap above the trend line, and it could be a gap and go, because there's probably people who are initiating shorts up here, and there are probably still some stops from people who are short above 1262. So I would be looking for that. I mean, it's still like 20 points higher, though, where it is now. So I would be careful with Priceline. If you're long Priceline, if it gets below the 1231.53 low of today, it's probably got some issues. So I'd be a little bit careful with that. But I would say that this is the time. If Priceline is going to be bullish, it should be bullish on this. I would be a little bit cautious if it runs hard before their earnings on Expedia. Sometimes Priceline likes to either dump or run hard on their print. I mean, on the Expedia print, and then it'll sometimes reverse on their own print because it's used up the move already. So if Priceline runs really hard tomorrow, I would use it to book profits if you're long. And if it dumps tomorrow, then you might want to be a little cautious because Expedia did have really good numbers. So that's my thinking. Someone asked me about Facebook. What do I think about it? Longer term, I am very bullish on Facebook. I do believe that the stock eventually will go to 100. That is my thinking. I still am sort of unwavering. I don't mean to be stubborn. I just believe that will be the case. But short term, I had discussed that we broke the 50-day moving average, and then yesterday was a failed retest. And I said that the risk there on a snap of 80, which had been an important level, there's some important levels in 80. There was like 79, 71. But the next important sort of swath of prints come in at the 61.8 Fibonacci retracement, which is 78.27. And in after hours, we are roughly right there. So the after hours low, I believe, was 78. Let me take a look. 1 day, 5 minute. The after hours low was 77.75. So, and now we're kind of rallying back up to that 61.8 fib, which we sort of, did we bounce off of it during? No, we kind of got close to it during regular trading hours and backed away. So I'm curious to see how that handles itself tomorrow. I believe that there should be some support within this band, the 77 to 78 area. There's also The 200-day moving average at 77.15. So this area, I believe, that we're sort of at the break of a volume distribution. This was also a point of where it's rallied, where it sort of rallied. This was sort of like the breakout area. And you've been down for multiple days. You used up a lot of the time, although one of the times that Facebook was in decline, it went down for like almost 2 weeks straight. But we have used up, in terms of price, a lot of the price. Excuse me. If this does wind up failing, someone asked what would be the next level. There's a lot of confluence of numbers in the high 76s, like 76, in the 7680s and the 7670s, like in that region. But the real risk you run on a snap, I mean, if that area does give, there would be room. I mean, you'd have to be assuming 75 or even possibly 100% retracement of the last run, which was 73.45. So if this area sort of fails, then there is risk lower. I would say that those 76. I mean, this area really should hold, quote unquote, if the stock is healthy. I think that a lot of people have sold up high. There's been a lot of responsive sellers, so maybe we'll find some responsive buyers now too. So we'll have to see how that goes. Anyhow, we're at 5:30. I have to be at an appointment. Thank you so much for tuning in. And be sure, like I said, be sure to follow me on Twitter. My handle is @JustinPulitzer. And be sure to watch my weekend videos. It's Justin Pulitzer Trades on YouTube. Be sure to subscribe. Yeah, one last thing. Yeah, Tesla does have the announcement tonight. I took off my short puts just because they had been worn down and I didn't like the risk reward anymore on them. If they do something like, I'm curious to see how Tesla is going to hold tomorrow. This 25-26 area was an important sort of resistance. It's now should be a support. If it loses that, I would be looking to do some type of a Fibonacci retracement on the last run, which has been, let's see, it would roughly put the stock, I had been discussing that 206 to 203 area being the sort of the old resistance and where it sort of was the launch point for this rally. If we could come back down into there, it's also the 50-day moving average. I'll be looking to resell those puts if we have some type of like a sell the news type of an event. If we do wind up breaking out to the upside over 238.75, then I'm thinking 245s and maybe even up to 245.89 and maybe even a gap fill up to 257.70. Wouldn't that be nice? So let's see how that goes. It's also going to depend a little bit on the market and how the news is perceived. I'm always a little bit cautious about sell the news, so let's just see how that plays out. Anyhow, thanks so much, and I will see you on the stream tomorrow, and we'll talk about more of these stocks and how some of this played out in the weekend video. I wouldn't be surprised if there was, we didn't really have so much of an underwater close today. We wound up, believe it or not, just being, and now in after hours, we're only like less than 3 points away from the VWAP. At one point, we were $16 away, which was a lot. So we'll have to see how this plays out. Anyhow, I will catch you guys tomorrow. Cheers.